Okay, so we'll start the session, students. Today, I'll take you to the Unit 5 of Investment Management, wherein we have the important problems which will be covered as well as some of the theoretical concepts. In this class, in today's session, I'll start with the theory, and the Unit 5 and Unit 6 are concerned. We have a lot of problems which are very, very important from your examination point of view as well as from your career point of view. So, giving you a small idea of Unit 5, kindly concentrate, students. I'll be going very slowly. If you have any query, you can be stop and you can ask me at any point of time. Okay. Students, can you see this slide?
Yes, sir.
Okay. So today I'll be taking you to the modern portfolio theory of Unit 5. I'll try to cover theory today and start the problems. If not, this entire week, the first hour I'll be taking investment management so that we can solve more and more problems related to Unit 5. Okay. So in Unit 5, let me give a small introduction. What all topics we will be covering in Unit 5. So the first one would be the Markowitz model, then Sharpe's single index model. Then we have very, very popular CAPM model that is called capital asset pricing model. Then in CAPM, we'll be discussing about the basic assumptions, the CAPM equation, the SML, also called a security market line. Then we have arbitrage pricing theory, that is APT. Then we'll be understanding the major difference between APT as well as CAPM. I think few more students are there. Let me. Okay. I think all of them have joined. We'll start the session now. So before starting the session, first we'll see what is today's opening of the market. And we'll try to understand where our Sensex and Nifty has opened. That is on Monday morning. So it's almost flat today. You can see 43,895.70. Okay. Then the NSE, that is Nifty, is concerned, it is 12,861, almost flat. We can even see the top gainers and losers also. Okay, we'll enter the website of BSE and NSE and then we'll see from the market. We'll observe the market for 1 minute, then we'll go for the slides. Okay, as you can see here, students, S&P, that is Standard & Poor's BSE Sensex, today morning 43,861. We are, the timing is 10:05. So it's almost flat, minus 21.24. Then you can see here some of the top gainers and losers for the day. Then we will quickly go for Nifty, that is NSE also. We'll see what is the market. Nifty 50. Today's opening 12,862.65. You can see the top right here. It's almost flat. What we can say. Okay, no major ups and downs, but we have to wait and see. Some of the major gainers for the day. Divis Lab. You can see here the first stock is concerned. Divis Lab. The last traded price is 3,591.80. You can even see the volume here, 5,08,495. Then IndusInd Bank, Bajaj Financial Services, then Reliance and Hindalco. And some of the top losers for the day is HDFC, ICICI Bank, Tata Motors, Axis Bank, and State Bank of India. Let me just open you Bajaj Financial Services and see the order book over there in Bajaj Financial Services. Today it is up by 255.40. You can see here. To my, you can see the cursor here. So the last traded price is 8,798 and it is up by 255.40. That means, Bajaj Financial Services, the volume is concerned, it is thin because of the market price. And DV slab also you can see here 3,585.85. It is almost up by 116.75. So if you can see the order book here, 3,19,422 buyers are there and 67,105 sellers are there. Okay, the traded volume for the day, 5,37,903 shares have been traded. The traded value is 19 lakh. Sorry, it's 19,029 lakhs. The total market capitalization of this company is 95 lakh 19,305. Okay, so this was about today's market of both both the exchanges, that is BSE as well as NSE. Okay, now today we will try to understand the theoretical concepts and then we'll go for the problems of Unit 5. First, I will take the Markowitz model, or first we'll try to understand the modern portfolio. Now, students, the objective of every rational investor is to maximize his returns, right? Everyone wants his returns to maximize and minimize the risk. So how do you construct a portfolio? Can anyone tell me? I'm asking you a question. How do you construct a portfolio? What are the parameters you will be seeing in the investor before constructing a portfolio? Suppose tomorrow if you become the fund manager or the portfolio manager of a company, so what are the parameters you will be considering before constructing a portfolio of an individual? Any guesses? Even if it is wrong, you have to tell me. What is portfolio? Anybody? In equity or in capital market. So what do you understand by portfolio?
So some summary of financial statement of the company, sir.
No, absolutely wrong. Steven, you are wrong. I'm asking you, what is the meaning of portfolio?
So number of equity shares holding in a stock, sir. Means total number of shares holding by a particular individual, sir.
Only shares or even money market instruments are there?
Even money market instruments like bonds and all, government securities.
Okay.
Sir,
Let me
it's a
summarize
details
now.
of our
Please
investment.
understand. Yeah, Prashant, you are telling something?
Yes, sir. It's a details of our investments.
Okay, very good. See, now please understand this. First, we will understand the meaning of portfolio. All of you, please concentrate. A range of investments held by a person or organization. I'm repeating once again. It is nothing but a range of investments held by a person or organization. So, portfolio can be equity, mutual funds, commodities, insurance, gold, real estate. Correct? So, portfolio is what? It's a collection of financial investments. It can be stocks, bonds, commodities, cash. People generally believe that stocks, bonds, and cash comprise the core of a portfolio. Correct? See, the definition of a portfolio is a flat case used for carrying loose sheets of a paper or a combination of investments or samples of completed work. It can be very simple. It can be like a combination of investments. Steven, you understood? Portfolio is nothing but a combination
Yes.
of investments.
Yes,
Clear?
sir. Yes.
Fantastic. Now, if I ask you, Steven, have you constructed your portfolio? What will you say? Yes. Have you constructed your portfolio?
Yes, sir.
Okay. So, what is your portfolio consisting of?
It consists of ITC, sir, and
Again, you are
Infosys.
wrong. You are telling me the name of the shares. I don't want. What is your portfolio consisting of? Sir, my portfolio consists of equity, sir. You have to tell like that, okay? Yeah, tell me,
Yes, sir.
Steven.
Yes, sir. Equity.
Only equity? You are not diversified?
No, sir. I have just now opened my Demat account, sir. So
Fantastic.
I'm just
Okay,
a
Steven.
beginner.
Now you understood the meaning of portfolio. Prashant,
Yes.
what is your portfolio consisting of?
Sir, equity only, sir, but thinking mutual fund also, sir.
Fantastic. Now all of you understood the meaning of portfolio, right? Now, my next question to all of you would be, on what basis you construct the portfolio? That is very important. On what basis you are constructing the portfolio? In unit 1 only we have studied, right? Sir, based on the risk of an individual, based on the return of an individual, based on the liquidity of an individual, based on the tax parameter of an individual. Correct? You simply cannot construct a portfolio for an individual. You have to first study his risk parameter, liquidity parameter. Then only you can give the financial instruments in his portfolio. Suppose tomorrow somebody comes to you, if you become a IFA, that is a financial advisor or a broker, and he will ask you, see, I am 75 years, I'm not ready to take too much risk, I have 1 crore rupee with me, so kindly construct a portfolio for me. So he will give complete 1 crore to you. So the first parameter for age old person is he is not ready to take risk. It is his hard earned money. It is his the corpus what he had kept for his retirement. Right. So you factor is high compared to other financial instruments. So you should be very, very careful when you are constructing a portfolio. So in unit 5, yeah, someone is telling Srinidhi, yeah. Someone is speaking, Srinidhi. Yes, anybody want to speak? Okay, suppose an individual comes to you whose age is 25 and he comes with 1 crore rupee and he tells you, I am ready to take risk and I am ready to wait for 10 years. So what will you suggest him? So first thing is he is ready to take risk. And the second thing is the time horizon. He can wait for the next 10 years. Yeah, what do you suggest him? Srinidhi or Vishal Ponaji? What do you suggest?
Sir, long-term
Sir,
investments
long-term.
is stocks.
Long-term investment, that to directly investment in equity or a combination, 80% of equity and 20% of mutual funds.
Yes, sir.
Combination.
Combination.
A combination would be better. Yeah, Steven, that is better actually. A combination, right? So all of you understood now. A portfolio can be constructed based on the individual's risk, return, liquidity, tax parameters, right? So first you need to inquire the individual whether what amount of risk he is ready to take and what is his return expectation and up to what how many years he can wait. So whether he wants the funds immediately, the liquidity should be there. So based on that only you can construct the portfolio. So in this unit 5, we'll try to understand the different types of portfolios as well as the risk and return parameters. And the proportion, very important students, please understand the term proportion of funds which can be invested. And if you change the proportion, suppose I'll give an example. I told you, you only told me combination, sir. We can plan for combination. So 80% equity and 20% mutual funds. Then also the return will vary. Will you agree with me? 80% exposure to equity and 20% to mutual funds. The return changes. Suppose I put 100% into equity, then also the return changes. That is what I'm telling you, the proportion of funds that will be invested. So in this unit, they'll be giving you the problems wherein they'll be telling you the proportion of funds invested is 50%, or the proportion of funds invested in 4 securities 25%. The proportion of funds invested in each security is 1/3, something like that. So what you have to do is you have to put the proportion over there and calculate the risk return and inform the investor that which portfolio is better for investment. Clear? So now I'll take you to the theoretical concepts. So first we'll try to understand the modern portfolio theory. Students, last I'm asking you, am I audible to you? Can you see my slide?
Yes, sir.
Okay.
Yes, sir.
Okay, perfect. Student, one more point I'm asking you. All of you are understanding, right? The portfolio meaning? Any doubt here? Because this entire unit stands on portfolio. All of you are understood the meaning of portfolio?
Yes, sir.
Okay. Okay, now first we'll try to understand modern portfolio theory, the conceptual framework and analytical tools for determining the optimal portfolio in disciplined and objective manner have been provided by Markowitz in his pioneering work on portfolio and analysis, which he has described in the year 1952 in the Journal of Finance. See, some of the popular financial models used in the process of valuation, stock selection, and management of portfolio includes Markowitz model, then Sharp single index model, then CAPM. So we'll try to understand very fastly all these things, then we'll go to the problems. Okay, first we will take Markowitz model. See, Markowitz, there was much consideration among investment industry professionals about risk and its implications on selecting specific securities and other type of assets when constructing an optimum portfolio. So Markowitz was of the opinion that each investor has a unique preference for the return and risk and possess a utility curve. This is absolutely correct, right? See what what your age is. My risk and return will be totally different because it changes for each individual, right? See, some of your friends can take more risk, but some of them are not ready to take more risk. Sir, no, sir, my capital is very important. So Markowitz clearly told that Markowitz was of the opinion that each investor has a unique preference for the return and risk and possess a utility curve. So it was very clear that to construct the optimum portfolio capable of meeting an investor's investment objectives within the constraints of his or her chosen investment horizon. So with a limited number of securities, an investor can create a very large number of portfolios by combining these securities in a different proportion. Each portfolio in the opportunity set is characterized by an expected return and a measure of risk, namely variance or the standard deviation. So all of you know, students, standard deviation means what? If the standard deviation of the portfolio is too high, that means the risk associated with the portfolio is high, right? So please understand this. When we calculate the standard deviation, when we are comparing two portfolios, if the standard deviation of that means portfolio A is higher compared to the standard deviation of portfolio B, so we can conclude okay. So we'll try to first understand this particular model, and then we will try to go for the assumptions of this. CAPM, that is capital asset, the capital market theory is the advancement in the Markowitz portfolio theory. The portfolio theory describes the way in which the rational investors should plan their portfolios. Capital market theory explains the pricing of assets in capital market as the investor work according to the portfolio theory. The capital asset pricing model, that is CAPM, shows the method in which the pricing of asset in the capital market is done. This model is easy to understand and has the worldwide application for knowing the market behavior. The model works on the principle that the systematic risk is linked to the security, which is equal for every kind of security in the portfolio. The risk of the portfolio is lowered by increasing the number of stocks. I'm repeating the word, students. The risk of the portfolio is lowered. That means The portfolio risk can be reduced by increasing the number of stocks, which decreases the unsystematic risk distribution by the number of stocks. The investor who do not want to bear the risk can invest in risk-free securities. The small investor having less number of security has more risk. Please understand this. Always remember, in your portfolio, someone told me, Steven told me, sir, in my portfolio, I have only equity, sir. So it is a bit risky, right? If you have 100% of exposure into equity market in your portfolio, it is risky. Though you are a long-term investor, so it is risky. So what I suggest you can change the proportion. Okay, so directly like 70% in equity, and remaining you can divide it, Stephen, like bank term deposit is there, and then insurance is there, gold is there, and then mutual funds are there, equity mutual funds. You can select some good equity mutual funds, right? So always remember, diversification
Yes.
plays a very, very important role when it comes to investment. And if less number of securities are there, if only less number of securities are there in the portfolio, that means the risk is also too high. So in your portfolio, always remember, whenever you are investing in equity market, you should pick the stocks, right? You can pick the stocks, and as this number of stocks increases in your portfolio, the risk can be minimized because you are diversifying into various sectors, right? And next, we'll understand the basic assumptions of CAPM model. These are some of the assumptions of capital asset pricing model. Investors' objective is always to maximize the utility of terminal wealth. And then investors have homogeneous expectations of risk and return. Now, what do you mean by homogeneous expectation? The investors have same expectation of risk and return, as the evaluation of mean and variance may result in different forecasts. So the outcome of efficient portfolio will not be the same as from the others. Then the third assumption of capital asset pricing model, in some of the papers they have asked students, explain the CAPM model with the assumptions. So this is again one of the important question you can consider, okay? So they have asked this question repeatedly. So this is one of the important question to understand CAPM. Investors make choices on the basis of risk and return. As I mentioned to you, obviously, if someone who is aged, or if someone who is young, can take more risk because he can wait for many years and he has the capability to earn. So as and when he earn, so he can invest to make an average of that, but not in case of a age-old person, right? Because for age-old person, he doesn't have any other income. So if the equity market drops, he'll be not having any second income to make an average of that. So at that point of time, it becomes very difficult for him, right? The fourth one is investors have identical time horizons. Then the fifth assumption is investors are freely and simultaneously available to investors. Now, what do you mean by that? So let me correct there. The fifth assumption is concerned. It is information is freely and simultaneously available to investors. The investors can go through the given information for free of cost, and there will be no wastage of time. It will be only applicable for the information which is different from all. The efficient and common frontier line can be drawn. So I'm repeating, students, the fifth point or the fifth assumption is concerned. It is information is freely and simultaneously available to all the investors. Then the sixth assumption of CAPM is there is a risk-free asset and investors can borrow and lend unlimited amount at the risk-free rate. Now here, there is one thing wherein if you are doing your project also related to portfolio construction, you need to consider this risk-free rate. Now, what do you mean by risk-free rate? Now, let me give an example to all of you. Suppose I invest 10,000 rupee in equity market. Now, what is my rate of return for 1 year, right? So I'll be calculating based on the income what I have generated from 10,000 rupees. Suppose this 10,000 will become 20,000. Okay, my capital invested is, please understand this, My capital, that what I have invested initially is 10,000, and that becomes 20,000. That means what is the income I'm getting from equity market? 10,000, right? That means how much percentage of returns I'm getting per annum? It is 100% returns, right? 100% per annum. So when you're calculating on a real-time basis, so what I need to consider here, the risk-free rate of interest or the risk-free rate of return. So for the calculation purpose, we'll be taking the treasury rate. Okay, the treasury rate. Even in your project also, you have to consider this risk-free rate of interest, that is denoted by the symbol RF. Okay. And then the seventh assumption is there are no taxes, transaction cost, and the restrictions on short rate or the market imperfections. And finally, total assets quality is fixed, and all the assets are marketable and divisible. Now, eighth point is concerned. The assumption explains that the liquidity can be ignored and the new issues of securities can be done. In case these things cannot be ignored, then the simple CAPM cannot have all that is important for pricing securities. So these are some of the basic assumptions of the CAPM model. Clear? Now we'll try to understand arbitrage pricing theory and CAPM. When we are solving the problems, I'll again explain you these concepts. Now, APT, also called as arbitrage pricing theory. So what do you mean by arbitrage? That we'll try to understand first. See, arbitrage is a process of earning profit by taking advantage of differential pricing for the same asset. And the process generates riskless profit. The arbitrage pricing theory was developed primarily by Rose. So it is a one-period model in which every investor believes that the strategic properties of returns of the capital assets are consistent with the factor structure. The APT, also called as arbitrage pricing theory, it is a substitute for the capital asset pricing model, in that both asset a linear relation between assets expected returns and their covariance with other random variables. The covariance is interpreted as a measure of risk that investors cannot avoid by diversification. The slope coefficient in the linear relation between the expected returns and the covariance is interpreted as a risk premium. Okay, so this was some of the basic theory related to the unit 5. Now we will go for the problems. I request all the students to have your investment management notes and the calculator in your hand so that we can solve the simple problem today. I request all of you to have the investment management notes and the calculator so that we can solve the problems related to unit 5. Okay. So shall we start, students? There is no answer. Monday morning.
Yes, sir.
Yes, sir.
Yes, sir.
Okay. Perfect. Calculator in your hand, everyone? Done? Okay. I know the students will enjoy the problems. Fantastic. So now, let me go for the first problem. Okay. Students, the slide is visible to all of you. Can anyone reply yes, sir?
Yes, sir.
Okay, perfect. Now, take the stock of ABC company and XYZ company. The returns expected from each company and their probabilities of occurrence. Expected returns and the variance are given below. The calculation procedure is even given in the table, which is mentioned in 17.1. So before going, as I mentioned to all of you initially, So first step, what we have to do, first we'll understand the problem. Okay. So what they have given, stock ABC company and XYZ company, two companies they have given. Please understand this. The returns expected from each company and their probabilities of occurrence. Their expected return and the variance are given. What we have to calculate, let me first analyze the problem. See, you can see the table over there. You can see the cursor here. This column is stock ABC and stock XYZ. They have given the return in percentage. See, 11 or 17, 20 or 8. Then probability, that means what is the probability of getting 11 or 17? It is 50%. That is, you can see here 0.5 each. Similarly, what is the probability? 0.5, that is 50% each. Next, students, you have to calculate this expected return, variance, and standard deviation. Okay. So first, what I'll do here, you can see here, all of you can see my cursor here in the problem. This is one of the important problem which they have, this similar type of problems will be given in the examination. So please understand this. Next problem you should only solve. Okay. Now ABC expected return. Students, first what I'll do here, what is the probability? 0.5 multiplied by 11 plus summation sign. Okay. 0.5 multiplied by 17. So first what I'll do, students, I'll solve for ABC stock. Which can anyone, everybody is solving? How much you are getting? Even if you are getting some other answer also, please let me know. $14? Yes?
Yes,
14,
sir.
Yes, sir, 14.
Okay. Next, see, students, XYZ expected return. So in this problem, what I'm calculating first? Expected return. Okay. First, I solve for ABC. Now I'll solve for XYZ. So for XYZ, what I do? I take 0.5. They have given me 0.5 is the probability. 0.5 multiplied by 20 plus 0.5 multiplied by 8. So I got the expected return of both, that is ABC and XYZ, to be equal to how much? 14. Right? Now I need to calculate the variance of the stock ABC as well as variance of stock XYZ. So how do I calculate the variance? You have solved it already, right? So, but probability we have to take it into consideration here. 0.5 multiplied by, see here, first I'll take 11 minus 14 whole square plus 0.5 multiplied by 17 minus 14 whole square. I'm repeating once again, students. First step is calculation of expected return. Second is we have to calculate the variance. So first we will calculate ABC variance. So what they have given me, 0.5 multiplied by 11 minus 14 square plus 0.5 multiplied by 17 minus 14 whole square. So please calculate and tell me whether you are getting 9 or any other answer, students. Remember here it is 11 minus 14 whole square plus 0.5 into 17 minus 14 whole square. Can anyone calculate? I want everybody to calculate. In fact, you are getting the same answer. Use your calculator. If you calculate more.
Same
Yes,
answer,
anybody?
sir.
You are getting 9?
Yes, sir, same answer.
Yes, sir.
Okay, only if you are solving. See, more you solve, more you will be, your hands will be on the calculator. In the examination, it will be easy for you. So you should use your calculator. Okay. Now, similarly, XYZ variance, I'll calculate. How do I calculate? 0.5 multiplied by, see here, students, 20 minus 14 whole square plus 0.5 multiplied by 8 minus 14 whole square. Please calculate and tell me whether you are getting 36 or any other answer.
36, sir.
Perfect. See, when we solve the problems, it is very, very easy to understand. I am telling to everybody, but it should be recorded on the same day to your notes. I'm repeating, okay? then only you will be perfect with the problems. Now, after calculating variance, it is very simple for me to calculate the standard deviation, because everybody knows that standard deviation is equal to what? Square root of variance. So what is square root of 9? Sorry. Square root of 9 is equal to 3. Correct? And similarly, XYZ standard deviation, that is square root of variance, square root of 36, it is equal to 6. So till here, everyone has understood what we have calculated. We have calculated expected return, then we have calculated variance, then we have calculated standard deviation. Till here, everyone has understood. Any query, please stop and ask me. Sir, it's very easy, sir. Problem, huh? Someone is telling? Shall I go for the next part? The problem still continues, students. We have to still calculate correlation coefficient for this problem. Shall I go ahead, or any problem, any doubt here? Divya Patil.
Yes, sir. Understood, sir.
Understood. Okay. Then Vaishnavi. Vaishnavi
doubt,
Parith.
sir.
Understood?
No doubt, sir. Yes, sir.
No doubt. Okay. Then okay. Next problem I'll ask you then. Rupa Paramgond. Good morning, Rupa. Rupa has kept the mobile and she has gone somewhere. Huh? Rupa. Good morning, Rupa.
Yes, sir. Good morning. Very good morning.
Where you have gone? You are there in front of your mobile?
Yes, sir.
Okay, you should reply. Okay, we will continue now. The problem is concerned. We have calculated expected return, then variance and standard deviation. So after calculating, let me tell you the small conclusion here. You can see the screen. Now ABC and XYZ company stocks have the same expected return. How much? 14%. But XYZ company stock is much riskier. Why? Because the standard deviation of XYZ is how much? 6. Please see the problem over there, what we have calculated, and see the table over there. The standard deviation of XYZ is 6. You can see my cursor here. Whereas the standard deviation of ABC is 3. Correct? Now, suppose the problem still continues. You can see my cursor here. The investor holds 2/3 of ABC and 1/3 of XYZ. The return can be calculated as follows. I'll repeat once again. Suppose the investor holds 2/3 of ABC, that is 2 divided by 3, and 1/3 of XYZ, that is 1 divided by 3. Okay? The returns can be calculated as follows. Now, what is RP here? It is return on the portfolio. Please remember these terms. RP, that is return on the portfolio, is equal to summation of, I'm using summation of T is equal to 1 to N. X is what? Please remember, X is proportion of the total portfolio invested in security 1. So proportion is, just now I explained you, 2/3 of ABC and 1/3 of XYZ. Okay. Then expected return on security 1. So in this case, how do we solve, or how do we calculate? So first, see students here, first let us calculate the expected return for both the possibilities. Possibility 1, what he has told, 2/3, 2 by 3 multiplied by 11 plus 1 divided by 3 multiplied by 20, which I got equal to 14. And similarly, possibility 2, 2 by 3 multiplied by 17, that is a return of stock ABC, plus 1 by 3 multiplied by 8, which is equal to 14. So I got in both the case to be equal to 14. Correct? This is just an example I'm telling you. 2 by 3rd of ABC and 1 by 3rd of XYZ. I got in both the cases the return, that is expected return, to be equal to 14. Now the next part in the same problem. In both the situations, the investor stands to gain if the worst occurs. Then by holding either of the security individually. See, holding 2 securities may reduce the portfolio risk. The portfolio risk can be calculated with the help of the following formula. All of you know this. I'm repeating now. Standard deviation of the portfolio, sigma P. Please remember this. Standard deviation of the portfolio is equal to square root of X1 square. So what is X1? Percentage of total portfolio value in stock X1. That means the proportion of funds invested in stock 1. Okay, x1 square into sigma 1 square, that is standard deviation of stock, the first stock, plus x2 square into sigma 2 square plus 2 into x1 x2 r1 2 means what? Anybody? Correlation coefficient which exists between stock 1 and 2, standard deviation of 1 into standard deviation of 2. You can see here R12 is equal to, how do we calculate? Covariance of x12 divided by standard deviation of security 1 into standard deviation of security 2. So please understand this. In this problem, first what we have calculated? We have calculated ABC expected return, then XYZ expected return, then we have calculated the variance of ABC and XYZ, then we have calculated the standard deviation of ABC and XYZ. Then after that, in the problem, if they give you what? Suppose the investor hold 2/3 of ABC and 1/3 of XYZ, what will be the return? So we have calculated in both the possibilities, right? Then after that, we are calculating now standard deviation of the entire portfolio. So that is sigma P. Sigma P is equal to square root of x1 square, sigma 1 square plus x2 square, sigma 2 square plus 2 into x1, x2, r12, sigma 1, sigma 2. It is something like a plus b whole square. That is a square plus b square plus 2ab. Okay. Now, using the same example given in the written analysis, the portfolio risk can be estimated. So first, what we have to calculate? We have to calculate the covariance of x12, right? So how do we calculate that? 1 divided by n. So what is n over there? Can anyone tell me what is n here? It is number of securities in the portfolio. So in my example here, in my problem here, how many securities are there? 2 securities are there, right? That is ABC and XYZ. So covariance of x12 is equal to 1 divided by n, summation of I is equal to 1 to n, R1 minus R1 bar into R2 minus R2 bar. Okay. Please understand this now. So what is 1 divided by n? 1 divided by 2 multiplied by 11 minus 14 into 20 minus 14 plus 17 minus 14 into 18 minus 14. I'll see here. So what I need to take here, see the problem here, all of you. So 11 minus 14 into 20 minus 14 plus 17 minus 14 into 8 minus 14. So now 1 divided by 2 into, I'll get minus 18 plus of minus 18, which is equal to minus 36 divided by 2, which is equal to minus 18. So what is correlation coefficient here? How do we calculate R value here? That is covariance of x12 divided by standard deviation of 1 into standard deviation of 2, which is equal to minus 18 divided by 3 into 6. What is standard deviation of 1? We have already calculated, right? That is 3 and 6. 3 of ABC and 6 of XYZ. So minus 18 divided by plus 18, which is equal to minus 1. So the correlation that exists between security 1 and security 2 is how much? Minus 1. See here, the correlation coefficient indicates the similarity or the dissimilarity in the behavior of X1 and X2 stocks. In correlation, the covariance is not taken as an absolute value, but the relative to the standard deviation of individual securities. Now let us proceed to calculate the portfolio risk. Now how do we calculate? I have already told you sigma p is equal to square root of, it is something like a plus b whole square, that is sigma 1 square x1 square plus sigma 2 square x2 square plus 2 into x1 x2, correlation coefficient that exists between R12, sigma 1 and 2, sigma 2. Now in the problem they have given 2 by 3rd and 1 by 3rd. This is very important, students. X1 is what? 2 by 3 square multiplied by sigma 1 square, that is 9, plus 1 by 3 square multiplied by 6 square is how much? 36, plus 2 into x1 is what? The proportion of funds that has been invested in security 1, that is 2 by 3, into x2 is what? 1 by 3 multiplied by correlation coefficient we have calculated. How much? Minus 1 multiplied by 3 into 6. Now, I'll not go to the next slide. I want answer from you. I want you to solve and tell me the standard deviation of the portfolio. Can anyone tell me? Yes, anybody? Standard deviation of the portfolio.
So 2.82.
2.82, sir.
Absolutely wrong. Just see where you have done the mistake. Absolutely wrong. Do it slowly. First, you do 2 by 3 square. Two divided by 3 whole square it is. Okay, please understand. 2 divided by 3 whole square. That means 4 divided by 9. It will become 4 divided by 9 multiplied by 9. Anybody?
Sir,
Zero.
2,
Huh?
2, 2.
Okay, perfect. Next. What is the standard deviation of the portfolio? You are saying 2. Oh, your calculation is. I want the standard deviation of the portfolio.
Sir,
Yeah.
sir, 0.
Who told? Who is this?
Sir, Kedar.
Perfect. Kedar is perfect. The standard deviation of the portfolio is 0. Okay, Kedar.
Yes, sir.
Yeah, first you tell me, Kedar, to all your friends, 2 by 3 whole square multiplied by 9. How much you got? Students, the answer should be 0. Standard deviation of the portfolio is 0 in this problem. Correct, Kedar, what he told.
Yes, sir.
Kedar, solve step by step and tell me the answer.
Sir, 4.
2 by 3 whole square multiplied by 9 is 4. Correct. Similarly, Kedar, 1 divided by 3 multiplied by 36.
Sir, 4.
Perfect. Next. All of you remember 4, 4. Yes. One, two, and third. Kedar, you have to tell this part. Anyone who has got 0? Answer to be 0? Ranjit?
No, sir.
Okay,
Yes,
solve
sir.
step by step.
Sir, I got 2, sir.
Huh?
I got 2.
No,
Answer is
no.
2.
No. Answer is 0. You solve slowly. Let me go step by step. See here. 4 plus 4. 4 plus 4 plus of minus 8 will become, which is equal to square root of 0, which is 0. All of you solved only this part now. This part, 2 by 3 whole square multiplied by 9, it is 4. Correct? All of you are getting 4 here, only first.
Yes, sir. 4.
Then here part, 1 divided by 9 multiplied by 36, 9 ones are 9 fours are. This is also 4. The second part. Next, here, it should be minus 8. This is minus 18, minus 18. 6 threes are 18. Minus sign is there, students. I think you have forgotten this.
Yes.
Minus sign is there. Correlation coefficient is minus. Okay. So 4 plus 4 plus of minus 8, it will become, that is plus 4 plus 8 minus 8. It will be 0.
Yes, sir, I got
Sir,
it.
can we
0.
go to the eighth slide?
Huh?
Can we go to the eighth slide?
Yeah.
Sir, in covariance of x112, that second line, 18 minus 14 is there, sir.
It has to be 8 minus 14.
8 minus 14, yes, sir.
It is correct. Actually, 8 minus 14, it is minus, the value what you will get is minus 18 only. So
Okay,
minus
sir.
sign is there. You only do solve it. It has to be, why 8? See here, what Vishal identified is perfect. See here, 8 is there, 8. By mistake, it has become 18. But in spite of that, it is a small, typing mistake here. It has come, minus 18 is correct. This value is correct. Vishal, what you have identified is perfect. It is 8 minus 14, not 18. 8 minus 14.
Yes, sir.
But you have to first tell me here, standard deviation. Someone got 0. Others
Yes,
are
sir, I
still
got
not getting.
0, sir.
Sir, I got 0.
Okay. Others, Steven, Ranjit, go step by step.
Yes. Yes, sir.
So it is how much? Everyone, any other answer? Please let me know if you are getting any other answer. Vishal, Yashaswini, Uma, Sushmita.
So got 0.
Okay. Sia Parab. Shweta Desai, Shruti Kalananawar. How much you are getting?
Sir, 0, sir.
0. Okay. Sarika Idiga.
Sir, 0.
0. Okay. See, if you do a small mistake in the examination, here itself, then it is 0. You will get 0. So please avoid mistakes, students. Even if you do take a small, value which is wrong, which is not mentioned in the question, so your entire answer is 0. And the value what you'll be getting is also 0. Now, what do you understand, students, here? The portfolio risk is nil if the securities are negatively correlated. This indicates that the risk can be eliminated if the securities are perfectly negatively correlated. So the standard deviation of the portfolios is sensitive to the proportion of funds devoted to each stock and the standard deviation of each security and the covariance between the two stocks. Now, in this problem, let me do a quick revision so that if any doubt is there, you can ask me. Now, what they have given in this problem, in this type of problem, they'll only give return and probability. Remaining all thing you have to calculate, right? So first, what we have to calculate? The expected return, then variance, then standard deviation. Okay. Now, after calculating that, we have to calculate the standard deviation of the portfolio. Standard deviation of the portfolio is calculated how? Square root of x1 square sigma 1 square plus x2 square sigma 2 square plus 2 into x1 x2 correlation coefficient r12 sigma 1 into sigma 2. So first thing is we have to calculate the covariance of x12. How do we calculate? 1 divided by n, summation of I is equal to 1 to n, r1 minus r1 bar into r2 minus r2 bar. In this problem, r2 is here instead of 18, here it should be 8. Then the value will be same. Value will be same. No problem. It is minus 18 only. Okay. So what happens here? Correlation coefficient R is equal to covariance of x12 divided by standard deviation of 1 into 2, which is equal to minus 18 divided by 3 into 6, which is equal to minus 1. So the correlation coefficient is minus 1, what we have calculated. Then after that, what we have to do? We have to calculate the standard deviation of the portfolio. See here, we have applied minus 1, that is correlation coefficient multiplied by 3 into 6. We get the standard deviation of the portfolio to be equal to 0. So the portfolio risk is nil if the securities are related negatively. So shall we solve one more problem related to this, or tomorrow shall I take? How it is? I want your feedback. Someone has replied, wait, 0. Okay. So shall I take one more problem, or tomorrow shall I take? Please
Sir,
speak
tomorrow.
frankly.
Sir, tomorrow, sir.
Okay. No problem. But any doubt here, Ranjit or any other student? Please ask me. Any doubt here, Prashant, Nivedita?
No, sir.
No, sir. No doubt.
No doubt. Then Ranjit, fast you tell me what all we have solved in this problem. I'll end it. Then only I'll end it. I'll take the next problem tomorrow, or else I'll continue. You have to tell
Okay,
me
sir.
step by step what all we have solved here.
Sir, today we had solved that we had found out the expected return
Hmm.
of ABC and XYZ of expected return. Then we
Fantastic.
solved that variance of ABC,
Hmm.
then XYZ variance, sir. Then standard deviation
Hmm.
of ABC and XYZ. Then
Okay.
we had came to this one coefficient of correlation.
Okay.
We had solved the coefficient of correlation, and last we had solved that standard deviation of coefficient of correlation, sir.
No. You're wrong. That means I need to take one more problem. Last, what we have solved? Last part of the problem, what we have solved?
Uh,
What is this?
Sir, it's not so visible. Let me check. Sir, coefficient. Sir, summation variance,
Hey,
sir.
no. What is this?
Wait, on,
Anybody?
sir.
What is sigma p? Anybody?
Correlation of coefficient.
I'll throw you now out of the class. What is this
So
symbol?
variance of portfolio.
Yes, it is called. See, here only it is mentioned portfolio risk. Portfolio risk. Sigma means what? Please understand. Risk of the portfolio. The last part we have calculated the risk of the portfolio. Ranjit.
Yes, sir. Got it, sir.
The risk of the portfolio can be solved using square root of x1 square, sigma 1 square plus x2 square, sigma 2 square plus 2 into what is x1 and x2? They're the proportion of funds which have been invested in security 1 and security 2 multiplied by correlation coefficient R1 to sigma 1 into sigma 2. Okay. Okay. Now, all of you today, please practice this problem so that tomorrow you will be perfect with the remaining problems. Okay. So thank you so much for your patience, students. Have a great Monday to all of you. So I'll stop the session today. Tomorrow I'll continue. Okay. Bye-bye and take care.
Thank you, sir.
Thank you, sir.